Picture this. You wake up, pour your morning coffee, and casually open up your investment app. You scroll down to your favorite stock, and suddenly your heart just completely skips a beat.
Oh, yeah. Because the number of shares you own has magically doubled overnight. Or, maybe even scarier, you log in and the stock price is literally just halved.
Right. But your total portfolio value hasn't changed by a single cent. And your first thought is always, have I been hacked? Is there a glitch in the clearinghouse?
No, definitely not hacked. You have just experienced what the financial world calls a corporate action. And, it's usually a moment of pure panic or elation for everyday investors.
It really is. Everyone frantically searching Twitter to figure out what just happened to their capital. But these actions, they're never random, right?
Exactly. They are highly strategic, heavily regulated maneuvers, whether it's governed by the Companies Act, SEBI regulations, or exchange listing agreements.
Which is exactly what we are going to decode today. So our mission for this deep dive is to completely unpack the nuts and bolts behind these moves.
Yeah, we are pulling our insights straight from Chapter 9 of the NISM Research Analyst Workbook. It gives a really comprehensive, factual breakdown of corporate actions.
Right, because we want to give you, the listener, an insider's lens to understand what companies are actually doing when they shuffle their capital structures. Management is pulling these levers for very specific reasons.
But to even participate in the outcomes of these levers, you have to understand the foundational mechanism first, which is the record date, sometimes referred to alongside the book closure period.
Okay, let's unpack this.
Yeah.
Because a company can't just, distribute a benefit to whoever happens to be holding the stock at 2:00 p.m. on a random Tuesday.
Right, the shares are constantly changing hands, millions of them a day.
Exactly. So the record date acts as a hard snapshot. If your name appears on the depository's records on that specific cutoff day, you are officially on the register of members.
And that means you get the dividend, the bonus shares, or whatever benefit is being distributed.
But I think a lot of investors miss the nuance here regarding settlement times. Because, if the market operates on a T+1 settlement cycle.
Meaning trades settle one business day after they actually occur.
Right, so you actually have to buy the stock the day before the record date to ensure you are on that list when the music finally stops.
You're touching on a really critical mechanical reality there. If you buy the stock on the actual record date, you are just too late. The trade won't settle in time.
You miss out entirely. So assuming you are on the register and eligible, let's look at the first major category of corporate actions. I honestly view these as the psychological accounting tricks.
The illusion of free money.
Yeah, exactly. Because these actions do not change the fundamental economic value of your investment one bit, but they drastically alter how the stock looks on your screen, like the stock split.
Right.
Instead of using that tired old analogy of cutting a pizza into smaller slices, let's look at this through the lens of market mechanics. A stock split is fundamentally about liquidity, right?
It is. When a stock's price gets astronomically high, it basically chokes off retail participation. The NISM workbook actually highlights a classic historical example with the State Bank of India.
Oh, right, SBI.
Yeah, SBI.
Yeah.
They had shares with a face value of 10 rupees trading in the secondary market at over 2,700 rupees.
For a massive bank, a 2,700 rupee share price just creates friction. It limits who can buy in, and that can widen the bid-ask spread because there are just fewer participants willing to trade at those levels.
Exactly. So what do? SBI executes a 10-for-1 stock split. They mechanically reduce the face value of the existing shares from 10 rupees down to 1 rupee.
And the math just flows through to the share price instantly. Because there are now 10 times as many shares floating around in the market, that 2,700 rupee price mathematically adjusts downward to around 295 rupees.
So if you held 1 share, you now hold 10. The total value of your holding is absolutely identical.
Right. But the stock becomes infinitely more accessible. It changes the whole psychological perception. A retail investor might really hesitate to buy 5 shares at 2,700, but they'll happily buy 50 shares at 295.
Oh, absolutely. And it also allows algorithmic trading programs and mutual funds to build positions with far less slippage.
Now, the reverse of this is a share consolidation. And that's equally fascinating because it's driven by the exact opposite psychological problem.
Yeah, share consolidations are typically deployed when a stock price has fallen so low that it creates this sort of toxic perception.
Like a penny stock.
Right. If a stock is trading at 5 rupees, the market might just write it off. So by executing a 5-to-1 consolidation, the company squishes 5 shares into 1, effectively raising the face value.
So a 5 rupee stock theoretically jumps to 25 rupees. But beyond just perception, there's an institutional mandate factor here, too.
Definitely. A lot of institutional funds literally have charters that prevent them from holding stocks that trade below a certain price threshold.
Right, so a consolidation pushes the price back over that arbitrary line, which keeps the institutional money in the game, even though, again, the fundamentals of the business haven't shifted a millimeter.
Which brings us perfectly to bonus issues, where the accounting gets slightly more complex. An investor might look at a bonus issue and think it is just a stock split under a different name.
I mean, the number of shares goes up, the price adjusts down, proportionate ownership stays the same. The end result looks totally identical on my brokerage screen.
What's fascinating here is the mechanics behind it. A bonus issue is actually an equity dividend. The company isn't just chopping up existing shares.
Wait, so they're fundamentally altering the liability side of their balance sheet.
Exactly. They are moving money from their free reserves into paid-up share capital, and the source material draws a very hard line here.
About what kind of reserves they can use, right?
Yes, a company cannot use revaluation reserves to issue bonus shares. Revaluation reserves are just paper gains. Like, if the company owns a building that goes up in value on paper.
Oh, wow. So they can't just make up value.
Wrong.
To issue bonus shares, they must use genuine, realized profits that have accumulated over time.
Right, strictly realized profits.
The signaling power of that is massive then. While a bonus issue doesn't put actual cash in the shareholder's pocket today, it's management permanently locking those realized profits into the capital structure.
It acts as a massive signal of confidence regarding future earnings potential. They're telling the market, hey, we have generated so much real retained earnings that we are comfortable expanding our permanent equity base.
Okay, so if a bonus issue is just shifting money around on the balance sheet to signal confidence, what does management do when they want to put actual spendable cash into our hands?
Well, that leads directly into dividends. Post-tax profits fundamentally belong to the shareholders. The board of directors has to decide whether to retain those profits for reinvestment or distribute them out.
And they can do that through interim dividends throughout the year or a final dividend at the end, right? I actually noticed the very specific SEBI regulation highlighted in the text about this.
Oh, about the declaration format.
Yeah. Companies must declare dividends in actual rupees per share rather than as a percentage of the face value. But why does SEBI care if it's a percentage or a rupee amount? Isn't math just math?
Well, mechanically, this solves a huge pain point for investors. It avoids total confusion. Say, Company A and Company B both declare a 50% dividend. A retail investor might assume the payout is identical.
Right, 50% is 50%.
But if Company A has a face value of 2 rupees and Company B has a face value of 10 rupees, that 50% translates to 1 rupee and 5 rupees, respectively.
Ah, okay. Mandating the rupee amount just eliminates the need for investors to dig through filings just to figure out what actual cash is hitting their account. That makes total sense.
It creates total transparency. And when that cash does hit the account, we have to talk about the tax implications, which are absolute.
Always a catch.
Yeah. In India, the entire dividend amount is now fully taxable in the hands of the shareholder, according to their specific income tax slab. Plus, companies have to deduct a 10% tax at source TDS on any dividend payout over 5,000 rupees in a year.
Okay, so dividends are the traditional route. But share buybacks have really become the modern standard for returning capital. And honestly, I look at buybacks with a healthy dose of skepticism.
A lot of people do because of how it impacts EPS.
Exactly. A company uses its excess cash reserves to buy its own shares from the open market and extinguish them. By shrinking the total number of outstanding shares, the earnings per share automatically goes up.
The math is unavoidable there.
Right. So I immediately wonder if a buyback is just financial engineering, just a way to hit an EPS target so the CEO can collect a massive bonus without the underlying business actually growing at all.
That is a highly valid critique of the mechanism. Shrinking the denominator does mathematically inflate EPS. However, the workbook outlines several distinct strategic motives for a buyback beyond just executive compensation.
Like what?
Well, first, if management firmly believes the intrinsic value of the business is much higher than the current market price, buying back shares is literally the highest return on investment they can make with that cash.
Okay, I buy that. Buying your own undervalued stock. What else?
Second, it serves as a major defense mechanism against hostile takeovers. By buying back and extinguishing shares, they reduce the floating stock available to an aggressor in the open market.
Interesting. And it also fundamentally alters the company's financial leverage, doesn't it? If a company is sitting on a mountain of idle cash, that cash is likely earning a very low return.
Right. It's just a drag on their metrics.
So by deploying it to buy back shares, they reduce their equity base. A smaller equity base means their return on equity, or ROE, suddenly looks much stronger. It shifts their debt-to-equity ratio, effectively making the balance sheet work harder.
Exactly. It forces capital efficiency.
Okay, so we've covered what happens when companies have too much cash. Let's flip the script entirely. What happens when the company is starving for capital?
When they need cash from you.
Right. They want to fund a massive expansion. Or they're choking on debt, and they need cash from the shareholder. What then?
This is the domain of the rights issue. When a company decides to issue fresh equity capital, it introduces the most dangerous concept for an existing shareholder, which is dilution.
Dilution is basically mathematical gravity. Think about it like pouring more water into a glass of lemonade, just watering down the flavor.
That's a great way to picture it.
If a company has 10 million shares outstanding and you own 1 million of them, you control 10% of the voting power and have a 10% claim on all future earnings.
Right.
But if the company issues another 10 million shares to raise cash, the total pool jumps to 20 million. Your 1 million shares now only represent a 5% stake. Your voting power and your claim on profits have just been cut in half without you doing a thing.
Which is brutal. To prevent that kind of immediate wealth destruction, the Companies Act mandates that any new shares must first be offered to the existing shareholders.
In proportion to their current holdings, right?
Exactly. You are given the right to maintain your exact percentage of the company before they go to the public.
And the incentive to participate is that these rights are almost always offered at a steep discount to the current market price. If the stock is trading at 500 rupees, the rights issue might be priced at, say, 400.
Right. There has to be a sweetener.
Here's where it gets really interesting. As an investor, you are presented with 3 distinct paths. You can exercise the right and buy the shares, maintaining your stake. You can do absolutely nothing, let the rights expire, and suffer the dilution.
Which you rarely want to do.
Right. Or you can choose the third option. You can actually renounce your rights.
Renunciation is key here because it allows you to monetize that discount. Since the company is offering shares at 400 when the market price is 500, that right has an intrinsic value.
So SEBI allows these rights entitlements to be traded on the stock exchange.
I do.
Which means if I don't have the liquid cash to buy the new shares myself, or if I just, don't want to allocate more capital to this specific company, I don't have to walk away empty-handed.
Exactly. You can sell your right to buy those discounted shares to another investor who actually wants in.
And the market will naturally price that right based on the spread between the offer price and the current trading price.
But SEBI governs this price discovery period very strictly. The rights issue must remain open for a minimum of 15 days and a maximum of 30 days.
That gives you plenty of time.
Right. This window ensures the market has enough time to appropriately value those entitlements. It gives you, the shareholder, ample time to make an informed capital allocation decision.
Okay, let's move beyond just raising capital and look at what happens when the very structure of the business itself needs to mutate to survive or grow. People throw around terms like mergers, acquisitions, and consolidations interchangeably all the time.
But structurally, they're very different beasts.
Right. Break it down for us.
Well, in a merger, the acquiring company completely absorbs the target. The target company's legal existence is completely extinguished, and all its assets and liabilities are absorbed into the acquirer. An acquisition or a takeover simply means the acquiring company buys a controlling stake in the target's stock. Both legal entities typically survive. One just dictates the actions of the other.
Got it. And a consolidation.
That's the most extreme. 2 or more companies combine, their old corporate shells are entirely dissolved, and a brand new entity is forged from the pieces.
Now, the textbook motive for all of this is synergy, right? The idea that combining a manufacturer with a distributor creates vertical integration, or 2 competitors merging creates massive economies of scale.
That's the official line usually, yeah.
But I'll push back on synergy. I feel like half the time the real driver behind these massive deals is just taxation.
If we connect this to the bigger picture, taxation is actually a powerful, often under-discussed engine for M&A. A highly profitable company generating massive tax liabilities will intentionally hunt for a target company that has accumulated significant financial losses.
Because by absorbing that target, the profitable company buys a tax shield. They can use the target's historical losses to offset their current profits, effectively neutralizing a massive tax burden.
Exactly. It's a huge financial incentive.
But how do they pay for these massive deals if they don't want to use cash? Because these deals are enormous.
They rely heavily on the share swap. The acquiring company uses its own stock as fiat currency. And the most contentious part of this whole process is the swap ratio.
It's not just a casual one-for-two exchange, is it?
Oh, definitely not. The swap ratio is a meticulously negotiated metric determined by independent valuers. They look at discounted cash flow models, market multiples, and asset valuations to arrive at the fair value of both companies.
So if the ratio is determined to be 1 to 2, a shareholder in the target company receives 1 share of the acquiring company for every 2 shares they are forced to surrender.
Right. And the acquirer achieves massive consolidation without draining their cash reserves.
Let's look at the inverse of that, the demerger or spinoff. This is usually driven by the need to unwind what they call the conglomerate discount.
Right, when a company does too many things.
Yeah, when a company operates in 5 different industries, the market often struggles to value it properly, applying a discount to the overall stock. A demerger breaks the pieces apart so the market can value each pure-play business on its own merits.
The NISM material actually anchors this with the Adani Group's restructuring.
Oh, right. What did they do again?
Well, in 2015, Adani Enterprises spun off its ports business, as well as its power and transmission operations, into distinct separate companies. And then in 2018, they did the exact same thing with Adani Green Energy.
And the mechanics for the shareholder are incredibly clean here. If you held shares in the parent conglomerate on the record date, you were automatically issued shares in the newly listed spun-off entity.
Exactly in proportion to your original holdings.
So suddenly, your tangled conglomerate stock has been separated out, and the market can assign a higher premium to the high-growth segments.
It's a great way to unlock value. But we have spent a lot of time on actions driven by growth, synergy, and capital efficiency. We probably need to address the reality of financial distress.
Yeah, bringing the mood down slightly. Corporate actions aren't always about growth and profits. Sometimes they are pure survival mechanisms or an exit strategy.
Exactly. When a company is drowning in debt and can't service its interest payments, the first line of defense is loan restructuring.
Which means what exactly?
They basically have to convince their lenders to alter the terms of the debt to avoid bankruptcy, lowering interest rates, extending the maturity dates, or perhaps converting a portion of the debt into equity.
And if the distress is too deep for simple restructuring.
Then the company enters into a scheme of arrangement. In India, this is a severe, court-monitored settlement process overseen by the National Company Law Tribunal, or the NCLT.
This really highlights the ultimate risk of being an equity shareholder. In the capital structure hierarchy, equity is at the absolute bottom.
The very bottom. During an NCLT reorganization, the creditors hold all the cards. The existing equity shareholders might be forced to relinquish massive chunks of their ownership to the banks just to keep the business operating.
Which brings us to the ultimate disappearing act, delisting, the permanent removal of a company's shares from the public exchange.
Right. And there are 2 types. Compulsory delisting is a punitive action. The company violates exchange regulations, fails to file financials, or commits fraud, and the exchange forcibly kicks them off the board.
But voluntary delisting is entirely different. That is a strategic choice by the promoters, the majority owners, to take the company private.
Right.
So what does this all mean for the everyday investor? Can a promoter just wake up, declare they are taking their toys and going home, and forcibly confiscate retail shares at whatever price they deem fair?
Thankfully, no. SEBI has implemented stringent minority shareholder protections to prevent expropriation. To voluntarily delist, the promoter group must cross a massive threshold. They must eventually hold over 90% of the total issued shares.
And the mechanism they use to acquire those shares from the public is called reverse book building. It's fascinating because it transfers pricing power to the retail investor.
How so?
Well, the promoter announces a minimum floor price, but the shareholders don't have to accept it.
Ah, right. Shareholders submit bids at various prices above that floor. The exchange aggregates all these bids, and the final exit price, the cutoff price, is determined at the specific price point where the promoter's total holding would finally cross that required 90% threshold.
So if the retail shareholders band together and demand a massive premium, the cutoff price will just skyrocket. The promoter then faces a choice: pay the premium the public demands, or walk away and cancel the delisting entirely.
It is one of the very few times the retail market actually dictates terms to the majority owner.
And if a company does successfully delist voluntarily, SEBI places them in a penalty box, right?
Yes. They cannot reapply for a public listing for a minimum of 5 years. And for companies that were compulsorily delisted due to violations, that exile is extended to 10 years.
Wow. Okay, we have mapped out the entire anatomy of corporate actions today. From stock splits manipulating the bid-ask spread and dividends returning hard cash, to the dilution risks of rights issues and the structural mutations of demergers.
These are the heavy mechanical levers that management uses to shape a company's financial destiny.
Right.
And this raises an important question. Analyzing financial statements only gives you a snapshot of a company's past performance, but analyzing a company's corporate actions reveals management's forward-looking intent.
It tells you what they're actually thinking.
Exactly. Are they locking in retained earnings with bonus issues, or are they constantly tapping the market with rights issues to cover operational cash burn? Their actions with the capital structure speak much louder than the letter to shareholders in the annual report.
Taking that a step further, it forces you to question what you are actually buying when you invest. We've seen today that actions like a stock split or a bonus issue change absolutely nothing about the underlying economic reality of a company.
Yeah,
Zero.
nothing at all.
Yet, historical data consistently shows that stock prices often surge on the mere announcement of these events. So as you look at your portfolio, ask yourself, when you buy a stock, are you paying for the actual fundamental cash-generating power of the business? Or are you just paying a premium for the psychological magic tricks of the management?
The mechanics don't lie, but market sentiment often ignores the mechanics entirely.
Open up your investment app. Dig into the history of the companies you hold. Look for the splits, the buybacks, the rights issues. See what levers management has been pulling while you weren't looking. You might be very surprised by what the mechanics reveal. Thank you for joining us on this deep dive. Until next time.